Welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a financial mediator and business valuation expert in St. Louis, Missouri. I'm speaking today with Michael Koeppel, and we've been doing a series about various valuation issues. Michael has actually been working for 30 years in various technology firms, manufacturing, service organizations, valuing firms, and also financing them in the startup area. He actually owns Lakelet Advisory Group located in New York. And like I said, we've been kind of working through really getting into some cases and kind of talking about major issues, but also looking at how does the valuation play into these various issues. So today we're going to talk about valuing the future, business valuation, and estate planning. Welcome, Michael. How are you today?
I'm doing great, Melissa. Thank you very much for having me. It's always a pleasure to work with you and your team.
Well, and valuation in estate planning is kind of what everybody traditionally knows. And so this conversation is geared a little bit more to the business owner and kind of understanding some of really strategic planning. Like, it's not just estate planning or exit planning or any of these other kind of catchphrases. It's you're a business owner, you're considering what you want to do in the future, and you have these options. Do I go sell out in the market? Do I have some internal people that I could sell to? Am I going to transfer some of these in an estate? And then there's also people that are just converting to S Corps. So I kind of want to just start pretty easily and talk about why we would need a business valuation in estate planning. And this is going to be an area that you may not have a choice. Like, the IRS is going to require you to provide a type of report through a certain appraiser and things like that. But why do we actually even need a business valuation? Like, if I know kind of the number, can't we just put that for the IRS?
Well, we more cases than not, we really don't know the number. Everyone thinks that their small, mid-sized company is the next Google and could have an IPO. And entrepreneurs, by their very nature, are optimistic. Otherwise, we wouldn't be doing this. You have to be optimistic. My company is worth X because I put my kids through college and I know the potential of it and I know the market, things along those lines. But you need someone independent who can step back and take a look at the overall company, the industry, and the players within the company. But the key word when estate planning is planning. A failure to plan is a plan for failure. You need to sit down and map this out and have a updated plan of the estate, what the company's worth. Now, when I say updated, I think dealing with so many estate professionals, the largest weaknesses of those that even do the planning, Melissa, years ago, is they don't update the plan. If you have an entity, a company that you've been working with and putting blood, sweat, and tears in it and it's 3 years ago, well, that company's not valued the same today as it was 3 years ago. Hopefully your blood, sweat, and tears is paying off in multiple folds, and you need to get it updated, the business valuation. The second thing is, when you do a business valuation, you really need to get someone who's done this. And the Internal Revenue Service, more so than many other sources, are requiring a professional business valuator. He or she has to be an ASA, accredited business valuator by the AICPA, has experience in this industry, because you have to appreciate that when we do estate planning and business valuations for the estate, it's generally not an arm's length transactions. You're going to be giving the company over to family members, friends, whomever, children, grandchildren, and the IRS wants to make sure they get their fair piece of the pie, as well as the individuals moving forward. So the planning is a cursor. It's a foundation to do all your estate and everything else. Have a business valuation in there, because for most of us, the value of your company is the largest value of the assets that you possess, and you need to plan for its transition. And as you properly said at the beginning of this, Melissa, you have a lot of options today with regards to the transition of your estate, of your assets. But as a fundamental thing, you have to know what it's worth. What is independently an accredited valuator? What is this entity worth? And then you can say, okay, here's my options. You can swap it over to an S corp for a host of reasons. You can even do ESOPs, and I know one of our previous podcasts was on ESOPs, or you can even do a transition, work with private equity, but you have to know what the fundamental value of the company is on a current basis and have it updated.
Well, and I think that you bring up a very interesting concept when you first started talking about this, is that most business owners' perception of the value of their firm is far greater than the actual fair market value of the firm, even sellable value of the firm. Now, we won't talk about divorce because everybody believes their business is worth nothing in divorce. But for the most part, business owners have sort of an inflated idea of what the business is worth. And so going through the business valuation process, especially in estate planning, is really understanding what is the fair market value, what is the actual tradable value, and is it supported? Because in estate planning, we actually typically are recommending to not only supply the report, but even, one of my favorite people is Michael Gregory, and he was with the IRS, and he even says to put a letter on the front of the report so that you're really outlining, like, hey, this is the value, like this is 20% of this company. Here's the discount I use. Like, tell them all the relevant information, and we're attaching it to a gift tax return, or we're attaching it to, a probate estate return, things like that. And it's required. Like, talk about a little bit about the IRS requirements, or, like, basically what do we currently have to do in order to make some of those transitions?
Yeah, no, I think that I've had the pleasure of working with Michael several times since president. Some of the stuff, he's absolutely right. And we do the same thing, a one-pager. You don't want to have the IRS digging through and say, okay, if you want to find this number, it's on page 72. No, they have a one-pager. These are some of the key assumptions we made. They were audited financial, and just list it one page in layman's term. If you forced the IRS or any other party to go through it, it's just unnecessary. You're almost asking for trouble. Now, with regards to the estate planning, Rule 5960 dictates, and I hate you quoting the IRS, but dictates how a business valuation has to be done and who can do a business valuation. First of all, as I said before, it has to be an accredited individual with experience in that industry, and that's paramount. And the second thing is you must examine the three tiers of a business valuation: the income approach, asset approach, and the market approach. Now, the IRS is not stating that you have to utilize all three approaches to come to your final conclusion and calculation, but you have to state to the IRS why some was preferred to others. And if you didn't use an asset approach, let's take, for example, it's a financial service company, very little in assets, most of it's in the market as well as the income it can generate in the future. We'll just explain to them in rational, it has to be a paragraph or two, or why that's not applicable. And they have a very detailed checklist of, I should say more than check, of what you have to go through and do it. The biggest catch right now, and it switches and trends, the biggest catch right now that the outside parties are looking at are the discounts. You have to substantiate your discounts. If you have a discount due to lack of marketability because a private company is not as marketable as a public company, you have to account for that. But you just can't take it out of the air like we used to be able to do 15, 20 years ago and say, okay, the average for a company, $50 million is 25%. No, you have to go out there, use Plurus or some other databases and quantify that and support it, because that 25 to 40% is such a significant number. And there's been a case made that perhaps that was abused, that pie in the sky number. So one has to substantiate that. There are many services out there that can help you do a business valuation with those parameters, but you have to use the appropriate sources. And the irony of it, the second got you with regards to the IRS, is sources. Put in footnotes, put in endnotes, document. If it's a website, put in the website, because nothing's worse. If you submit an estate planning issue for the Internal Revenue Service today, it's going to be at least 9 months before Uncle Sam takes a look at it. And when you're called, or even, let's even put away the testifying later, if you're called to, you don't remember every business valuation did. You have the URL there, you have the footnotes there to refresh your mind, and have it in there. You don't want to have to say, oh, it's in my working papers. You don't want to introduce that aspect. The report needs to stand on its own. You don't want them subpoena or getting all your working notes or anything like that. You want the report to do all the talking. I know it can, as a result of this approach, it can be very voluminous to report, but it addresses all the needs that it does on its own. And don't use the template report systems. There's some software out there. You get what you pay for. A template, every company and every situation is different, and you have to be able to accommodate that. And secondly, you lose credibility when you use the template approach. The Internal Revenue Service, the courts, everything, they've seen so many business valuations. They know if you're using the cookie cutter software, and it doesn't carry much weight.
Well, and I think that these reports typically could be 50, 100, 150 pages long. And initially when people call, they will be like, okay, I'm doing some exit planning, estate planning, strategic planning. What are the discounts going to be? Like, that's almost their initial question. And that's the only thing that they're thinking of is, okay, whatever the value is, can I reduce it by 50%? Like, am I going to come under the exemption? Like all of these things that realistically, that's where they're focused on. But the proof of it is almost more important, right?
Right.
And the substantiation.
You have to go through that process to get to it. It's like you have to play the full game to see who wins and loses, and you have to go through the whole methodology for it. And that's what the IRS is requiring now. Don't just give me a number and you approve. So many times, we get people come in there and say, well, I looked up my multiple is 6.2 in my industry, so I'm going to take my EBITDA or my earnings and multiply it times this magic number 6.2. Assuming the 6.2 is correct, that might be for the average company. Your company may not be average. You may have a stronger or weaker bench. You may have a product concentration. You may have a whole litany of issues that are relatively abnormal. So you don't want to use that methodology, and don't get caught using that methodology. Number one, it's not going to fly. And number two, it's just wrong. It's not accepted. There are ways of going out there if you're going to use the market approach, but there's a whole array of characteristics that need to be explored. And that's why when the IRS they want you to use all three different methodologies and a weight to it. Okay, the market is like 40% weight. Income is 50%. And if it's a manufacturing facility, maybe 10% on the asset. You got to mix it up and say, okay, and that comes from professional judgment. And that's why emphasis is placed on experience and professional judgment, especially with regards to the Internal Revenue Service.
Well, and the reality is doing a valuation for estate purposes is an insurance plan. Like you're putting a value in place, you're supplying it to the IRS, and you're making sure that you validated what you did so that it withstands the scrutiny. And so if you don't really provide enough to withstand that scrutiny, or it's almost like a target that you go in and you're like, oh, 75% discount. It's like, okay, here's the target, here's the target. Oh, 3 pages of a little report. Okay, that's creating a target, and it's a $50 million valuation, right? Like the IRS is not, oblivious to these things. It's almost like they even know the things that they're looking at. But from that perspective, we usually see kind of three general areas where you would need a valuation, because there's a lot of, like if you decide to just go sell your company, you can get a quick and dirty valuation. You can get a reality check. When you're doing some of these other things, and we'll start with one of the simple ones, because before you're even thinking about gifting, you might be converting to an S Corp, right? And in the past, sometimes you'd be like, oh, we'll convert to an S Corp, and if we need something in the future, we'll value it in the future. That's going to be kind of a red flag target. So talk to us a little bit about why you would need a valuation if you're in this type of situation for converting to an S Corp.
Well, you need to take a look if you're going to convert to an S Corp or an S Corp to a C, but usually it's C to S, is to take a look at the tax savings, which could be significant. And you also have to take a look at the characteristics of the company. There's a lot of times where an S Corp may not be applicable, especially with regards to estate planning. It's going to depend on the industry, the size of the company, etc. You need someone to go through there and say, okay, here's the pros and cons, and here's the impact with regards to the estate and the business valuation. Now, if it's an estate planning and you're going to use an S Corp, there's significant advantage to doing that if the individuals you're going to be sharing the company with in the future are family members and less than 15 or 20 people. There are a whole host of reasons you may want to explore taking that avenue. But you need to check it. Don't use everybody's using the S Corp thing, so I'm going to change it. There might be a big got you down the road, and it is not easy going from back to a different corp. So once you go from a C to an S, you don't get a do-over and say, oh, this was a mistake. I'm going to go back from an S to a C because the tax ramifications to the individual I'm going to be sharing the company with in the future. Well, no, it doesn't work that way. Once you lock in, you're pretty well locked in, especially if you're doing ESOPs. There's significant ramifications between the two.
And why are we even required, or is it a requirement to do a valuation when you're converting to an S Corp?
You want to do a valuation and a financial analysis in advance. So once you pull the trigger, it's easy to pull the trigger. It's just a one-page form. I want to go from this form, but the ramifications are monumental. So you have to take a look at, okay, what's the impact of doing this? Not only with regards to tax, your marketability down the road, all a host of interests, that your estate planning with the estate attorney or your financial plan. You need to go through all those and make sure that there's no got yous down the road if you do this. And there's going to be some pros and cons. It's not that simple as people make it out to be. And you have to make an informed decision on all the options you picked. You say, okay, you're right. There are some disadvantages if I go to the S Corp, but there are greater advantages. But at least you have an informed decision, not a couple years later or the next year when you file your returns, or in the event something ever happened to the owner, they can say, oh boy, if only I would have known this in advance.
Well, and I think that sometimes I'm seeing people convert, from a C Corp to an S Corp because in the future they do plan on selling in some capacity. Do you think that that is one of the major reasons that people are doing that, or is it, a host of other tax reasons?
I think it's a host of other tax reasons as well. If you're going to plan on selling the company, it all depends on who the buyer is. Now, if the buyer is a private equity firm, or the type of sales, if they're not buying the assets, if they're buying the stock, what are you selling down the road? If you go to an S Corp without these informed decisions, you may be hurting yourself. You could, if you say, okay, it doesn't matter, I'm going to sell just the assets of the company and it's going to be the so-and-so group, and, this becomes the buyer's problem. Well, there's only so many problems you want to push down to the buyers. Or in some cases, it may be a great asset to the buyer. Again, it's on the planning. It's so oversimplified now, and it's really not a simplified decision to make with regards to your company. Now, does it save taxes? Generally, it will. But what are the ramifications? There's no such thing as a free ride. There's pros and cons to it, and you have to have that informative decision in a checklist to go through and do it. And sit down with someone experienced in this area, and they can tell you within a couple of hours the pros and cons of doing this.
Well, and another thing that people will typically look, so they're running a great business for 20, 30, 40 years, right? Primary founder, and they will start knowing that they need to do something, right? They don't know if family members could take over this business. Maybe they have a good management team, but it's interesting because when I talk to business owners, I was like, well, you could consider gifting your shares. And they're like, what are you talking? Like, I would just give them to like, what does that mean? But in reality, some of the beginning stages of even figuring out how you're going to transact that business in the future, there is another estate planning kind of concept, which is moving the shares, the stock, the company into some sort of trust. And I'm trying to make it simple because there are like so many different trust instruments that you can use to do this. But just in general, I think that business owners are like, why am I doing that? And some of it is moving that down, like those shares to family at a time before you go to sell it so that you're not having that tax impact. But can we talk a little bit about this typical estate planning structure, which is creating a trust, moving the company into a trust, and then eventually thinking, are you going to gift? Are you going to sell it? Are you going to do something? Do you see that as a kind of normal way that people are proceeding through the estate planning process?
Yes, I've seen it much more in the last 2 years than I have previously. Part of it was because of the uncertainty with regards to the taxation between the prior administration and the current administration, what's going to look like, what's going to happen, what's capital gains. No one knows this stuff. Even Congress doesn't know. So that, and amongst other things, they're not sure of, but that's an editorial comment. Right. But let me say, hypothetically, suppose Mrs. Jones owns 75% of ABC Company. And she's 65 years old, and she plans on retiring on her 70th birthday. And with the 75% she owns, she knows there's going to be significant tax liability to the family, assuming the family can afford to pay the tax liability when they get the company. So what it may behoove her to do is take maybe over the first couple of years, 15% of the company and still gift to her beneficiaries. They may be her family members, they may be certain employees, the whomever. Then the liability of the company is significantly less when it's transferred. She may still have 51% of the company. She still controls the company. And like you said, there's a whole array of trust she can do to make sure she can control the company. But that's another conversation. But let's suppose she keeps the company and she can still run the company. And then once she wants to sell it, get rid of it, and the money was going to go to her heirs or whatever, that's already taken care of at a minimal tax benefit. And if done properly in certain stages, at almost no tax liability at all.
Yeah, absolutely. And I mean, you brought up another concept, which is a lot of times people are establishing voting and non-voting shares. Like the old adage would be kind of 1% is voting and it owns it and you're gifting 99%. But that's, I've seen more different ways of doing that where you're maintaining 51% or you're doing different percentages. So again, not getting caught up in some of those percentages and things like that. At the point that you're moving the entity into a trust, you're kind of creating an internal transaction, which is one of the reasons why you would actually need a valuation for that process.
Much more so in this scenario that we're talking about, Melissa, because it's not an arm's length transaction. The methodology we use from our accounting days, you doing this to a related party, a family member, and that in that case, the burden of proof is on the taxpayer that that's accurate. And you need to have that business valuation by an accredited independent professional to say, look, in my example, Mrs. Jones passed over these 15% of the shares. Here was the value of the date before that, and here's the shares. And I've seen many times where you would even include the plan. So if something happens, you have, here's the plan and here's what she's doing. So when the date and event occurs, it's falls into place with them. So they realize the IRS, as well as other parties. And I might want to say and I say as well as other parties, it's not only the IRS. We've all seen situations where other family members may not have gotten the money from the estate as they anticipated. Maybe in my illustration, Mrs. Jones, 3 of her grandchildren worked at the company from college on and 1 didn't. Well, she's not going to, maybe she doesn't want to give the 25% or percentage to the one who didn't. It's going to be contested and they're going to have to go through all this process. You need to have that documented trail before that. Otherwise, it can be tied up almost ad infinitum. It's just absurd once it goes into judicial review and process, the amount of time before people get the money.
Well, and
but if you use your idea, think about it. If you use your idea and give the gift before that, they've already got a good portion of the money already. And the court knows, well, this was all her intent because he or she just gave 15% to the 3 grandchildren that worked and did get squat to the one who didn't go off and work at the company. So there's some precedent, and it carries a lot of weight to have the plan done properly like that. So the gifting is a very good process for a whole host of reasons in addition to the tax situation.
Well, and in both situations, if you're converting to an S corp or you're moving it into a trust or you're gifting the shares outright, there are times where, you don't have to do a valuation. Like you can wait in the future and say, well, if the IRS comes back and takes a look at this. The problem with that, and I think that sometimes people will do that because of the cost of the valuation, and the cost could be $15,000, $25,000 for this valuation. It could be less. It just depends, right? You got to talk to people and see what is included. The reality is, if you don't do it at the time that you're understanding that you're making these big decisions and you're basing the decisions a little bit on the value. If you go, just think about it. Like we agree, Michael and I agree that we're going to transfer this into another organization, trust, and we're going to gift these things. And then further on down the line, we decide that we're going to do something different, right? Yep. Or we didn't quite know it. And now we need a valuation to be retrospective, right? To go back 3 years. I think that a lot of people are going to look at that as a little contrived, because you're now coming in to value it. You know what you need it to look like, right? Based on this, as opposed to when you're valuing it at the time that you're doing it, you're actually using the valuation to help you make the decisions that you need to consider. Like, are you past your exemption in your estate or not? Like these are kind of bigger issues to look at. And I think that not taking care of that valuation because of the cost, because of whatever, and not even papering it up so that it's sitting in the file. If the IRS comes knocking a couple years later and they're like, okay, where's that valuation? And you're like, oh, let me go get one for you. Right. What would you, it just seems like it's going to be contrived at that point. Right?
It's a challenge to go back and do it retroactively. Yeah. For those of us who also do divorce valuations, that's also a big challenge of the date that they were married and try to go back. And is suspect at best with some of the assumptions we're forced to generate. I would strongly recommend that you get a business valuation and you update it annually. Now, let's use your example that you stated, Melissa, and I don't know, we're just tossing our hypothetical numbers. It's $25,000. But to update it on an annual basis, it's like someone does for an ESOP. It might only be $5,000 to update it and keep it current and going with it, because you don't have to reinvent, the players, but you have to do it. I mean, you have to make the commitment. You can spend more on that with the litigation, IRS problems, and everything going back and forward and doing it right. There's a reason you have to do it properly, and there's a reason companies are the larger companies to go through the public audits and all the other stuff. You need to have this on an annual basis.
Well, and
even now, I might interject that public companies now are forced to do their own version of a business valuation year with fair market value accounting with regard to certain assets, the fair value. You have to go through ASC 820, ASC 805, and go through it and update your value of your company, your assets, as if they were on the fair market, and the historical has very little meaning anymore. So everyone's recognizing this, and you need to do that for small, mid-sized companies. You really do.
Well, and small
it's
companies,
insurance. I'm sorry, it's the insurance process that you said before, Melissa.
Absolutely. And smaller companies, under 10 million in revenue, I would say typically are very aware that they don't really know what the value of the business is. They're more willing to talk to somebody and say, like, what is the value? Because again, when you get into 20, 30, $50 million companies, they have CFOs, they have inside and outside accountants. They're doing some version of a EBITDA, like they're looking at some version of the valuation. And those are the people that will have a tendency to be like, well, we kind of know what the number is, but can you stand on it? Like when the pressure comes to you and says, well, is that really the number? I think the business owners are like, well, I think it's the number. I don't know.
Yeah. And I would just interject that when I do a business valuation, especially within our firm, it's more than just crunching out the numbers. The business valuation will pay for itself. Let's take a relatively small company, $10 million, and a 10% EBITDA earnings before interest, depreciation, amortization, and it's $1 million. Keep the numbers simple. It's a long day. Let's keep the numbers nice and simple. So it's $1 million. When we do the valuation, we can sit down with the owners and say, look, if you would do A, B, and C, your valuation next year, instead of being $1 million, would be $1.4 million. It's just a few simple things you need to do in the process. It may be go from a bookkeeper to a controller. It may be to mitigate your exposure to one customer. It may be geographical presence. It may be insurance. It may be cyber insurance security. There's a whole host of little things that an owner can clean up at that size company and add significant quantifiable value in a very short period of time.
Well, and if you start to look at converting to an S Corp or moving shares into a trust or gifting, you are typically, that's going to be one of the first times that you may have a formal valuation. And so what we're saying is, yes, that seems like a one-time scenario, but as we're going forward, what we see in the M&A world or in the mergers and acquisitions, whether it's private equity or private sales, when you go to sell the company, there's going to be also a host of ways that you can sell it. You can sell it outright in an auction style process, hire an investment banker, hire a broker, go find some buyers. You can sell it to management. You could even, maybe you don't want to gift it to family, but you want to sell it to family. Sometimes you'll have family that 2 are in the business, 2 are outside of the business. So we're like gifting some shares or remove, The other is an ESOP when you have management, because typically you can't gift to anybody other than a family member. And so now you have ways that you would maybe pay them out through the company in order to give them a bonus that they're then buying these shares back. But I believe you should start every company with the end in mind. Like you should start a company knowing that at some point you're going to exit and you're going to quantify it in some capacity. But if you look at that, that is going to be the primary reason to have a yearly valuation. If you have partners buying in and out, you create a transparent process but talk to us a little bit about, in like a traditional ESOP, which I don't see, I see people doing things that look like an ESOP that feel like, that you're selling internally and things like that. So talk a little bit about that piece of estate planning.
Yeah. ESOP's a very unique animal, and it's growing. I mean, over the last couple of years, it's a 10% increase in the number of ESOPs. There's 65,000 now in the United States, and 14 million employees are under an ESOP. The only reason I know these statistics, I just gave a presentation on this very topic last week. And ESOPs are a great opportunity. I want the listeners to appreciate, though, if you go to sell the company and you go to a private equity and say they will probably offer you, I'd be shocked if they didn't offer you more than an ESOP. Okay. But the ESOP is, you may not have to pay taxes. If you sell it to a private equity, you're going to have a nice tax bill. If you do an ESOP and do it right and have professional people advise you and go through it, you can kick the can down the road on your tax liability almost ad infinitum. Minimal taxes. You just keep it in a certain qualified plans and you won't have to pay taxes on it. And that is so, unless the private equity firm is significantly higher, say at least 35% higher, you may be better off exploring ESOP. Plus, also in ESOP, you want to take care of the employees and the people who made you wealthy. And that's a key piece. And the other advantages of an ESOP versus a management buyout is the management may not have the money to do the buy it out, where an ESOP helps provide the funding to do that and provide the funding, and also the tax benefits of getting a loan via ESOP umbrella is significant, and what you can deduct the principal payments as well as some interest if you do it properly. So it can be a significant thing. Even if you're going to sell the company to anyone else in the whole of all these options we explored, you have to know independently, what's your company really worth? What are your options? You sit down with the financial planner and they'll help you with the options, but you need that valuation as a foundation. What's the ballpark that you want to get? Who do you want to sell it to? Who are you willing to sell it to? But basically, what's the company valued? Some of these problems, for example, ESOP, during a business valuation, someone, the valuator who's experienced in ESOP, may just tap you on the shoulder and say, look, I appreciate you want to sell it to the employees, but this wasn't going to work for an ESOP because of a whole host of unique reasons. Please appreciate when you deal with an ESOP, you deal not only with the IRS, but also the Department of Labor. You have to have so many employees. You have to set certain things up, and it's not applicable for everyone. You have to have a certain size. You have to have a certain earnings ratios. You have to have certain things in there that make it worthwhile. And to tell you the truth, ESOP is somewhat contingent upon industries. So it may not be a good fit for you. That's why a valuation as the floor, as the foundation, and someone who's done it can point you in the right direction with regards to your options.
Well, and I think realistically, when you're considering that other owners are going to start owning your company, whether you use the ESOP rubric as, like typically you're the owner, you're going to get a consultant that comes and gives you an idea of what the value is. The ESOP or the employees are going to need a third-party valuator that supports them, which is going to be not necessarily who you hire. They're going to be hired. And then they do this repetitive valuation each year. Now, we're typically working with people that are kind of doing things that are similar to an ESOP, but they may have 2 employees, or they might have a family member and an employee, and they want to be selling to both of them. What happens is you now have an outside party that's going to be looking at your financials. And so in my mind, you need to be consistent with the valuation methodology until it changes. But the transparency now becomes like, before you just did things and you decided. Now you have 2 minority partners. You now at least have the obligation to be providing them with financial information, to be providing with them with the basis of how they're going to buy in each year. Or, okay, now you have somebody that wants to be bought out, right? You have that, you're creating this kind of flow back and forth, which is another reason why you would want some sort of consistency and thinking about how you're going to value it for those buy-ins and buyouts. What makes sense with the discounts, without discounts? Like that could go into a buy-sell agreement or the operating agreement and dictate it, as opposed to, well, we'll value it each year in this hypothetical manner. Like, why don't you establish a process so that your employees know each year we're going to look at this, we're going to review it, we're going to ask questions. It's going to be maybe the same valuator coming in and understanding the business and saying what changed. Those types of things. Are you going to value it in the future? Are you going to do a DCF? Are you going to value it from the past? I think that those types of things are what we might talk about in the case study too.
Yeah, those things are very, very important. And even becomes an additional dimension of complexity, Melissa, is when you deal with professional service organizations and the goodwill. If someone you're doing the estate planning and one of the partners, say, is a world-renowned surgeon and he's no longer with that organization, well, the value is going to be significantly impacted. Or in the case study that we'll make available to everybody on estate planning is, the one owner owned 75% and the chief operating officer, she owned 25%, and they've been together for years. And the situation is when the owner leaves, she's going to leave. So the ramifications of that and the value of a company is significant. So how you go through the planning of that and make sure that there's someone to run the company after that. I mean, you can't force people to stay on with the company. The only reason they're together, they co-founded the company together, and they want to continue to do it, and they want to go out the door together. Well, heaven forbid that they don't get that opportunity if the majority owner passes and they don't have a plan on what's going on. The company becomes almost worthless or significantly deteriorates the value of the company.
Well, and let's get in, because we're gonna end it with some of the impacts of the current tax laws and stuff, but not everybody loves the tax concept of it. So we'll finish with that. But let's look at this, because this is going to give us just kind of a simple example of something in this estate planning space. So maybe you can set us up and give us some background on this valuation case review, and really why is looking at some of these different types of case studies important?
Yeah. The client was making about $37 billion in revenue. And of that, about 11%, say $4 million of net income. The company has about 140 employees, and the company is in Illinois. The reason I bring in the state, and the state's very important, because there's estate taxes in that state. Every state is different, and the requirements for that and passing it through are different. Now, the other challenges in the state planning business valuation was the majority shareholder, who owned 75%, had a couple of family members working for the company. Some of them were phantom employees. The daughter probably never stepped foot in a factory, and yet she was getting paid for college and getting a regular salary. Now, the minority player was compensated by, he was getting a car and a car for his wife. Now, these are all things, and it's their company. They can do what they want with it. But when you value the company, you have to adjust for all these factors, because they're not normal occurring business factors that someone else would take into consideration. The other thing was, he was doing so well with the company, he took out an additional $890,000 in salary, above and beyond what the fair market value was for that position and salary. I mean, he could have done it through dividends or other approaches, but he was taking out the $890,000. And so we just add that back to the company in there. Those are things that we have to take a look. We took a look at the income approach, and we took a look at the assets. Assets were predominant because it was a very specialized industrial manufacturing company. And we also take a look, okay, what the market looked like. And we came up with the valuation of whatever it was, X. The big challenge we had was the discounted marketability, because they couldn't sell the company immediately as if it was a public company. And in this situation, there was about, I think, a 25 or 28% market value in there. The other thing we had to do in the case study is, when we're doing the estate planning, is we had to find a way to ensure that the minority owner would stick around, because if they cashed out at the same time, those two not only were the rainmakers, but the minority was the chief operating officer. The majority was the true rainmaker. So without operations and someone bringing in the business, the company's value would go down significantly. So we put together some handcuffs, for lack of a better term, to make sure that the chief operating officer would stay on past the event being the passing of the majority shareholder. And that added significant value to the company, because it mitigated the risk of anything happening to someone else. And he would stay on for a period of 3 years and get additional stock and a nice retention bonus at the end of the 3 years. The reason I bring up some of these characteristics is to show that each case is different, and you have to go through all the cases. The fact that it was in the state of Illinois had a big difference versus if it would have been in the state of, for example, Nevada, which we've also done some in the state, but there is no tax. Well, Illinois, New York, obviously California. The different rates and the different tax structures is different between the states. And I might add, significantly different for estate planning purposes. Each state is probably much more so different than anything else, with the possible exception of divorces. Then there was some goodwill involved in it from previous acquisitions. How would it be? But all these things and summaries had to be taken into consideration in terms of what the fair market value of the company was at the date of the valuation. We've been asked to update that because there's been significant changes. One change that happened in last year, 2024, is they broke the customer concentration. One customer was about 33% of their business, which was a high-risk customer because they didn't have long-term contracts for them. One, we were able to get a long-term contract to mitigate the risk. And secondly, we got another international company to bump it up 10%. So the concentration went down significantly. Now, when we do the valuation in a couple of weeks, they'll definitely positively impact the value of the estate plan, because the risks are gone down. And the fact we're able to tie up the chief operating officer for another 3 years, the risk has gone down. These little things are not so little. The valuation, I suspect, just off the top of my head, knowing the company, is going to add at least 25% to the valuation because of the process. Not only the process that we did initially, but also the fact that we annually can update it. And they took some of our suggestions. For example, the suggestion of locking down the chief operating officer, take care of the customer concentration, take care of a couple other things. And if you're going to pay yourself $890,000 surplus, maybe take a look at it and give them a dividend, or find some other way of doing it. Why pay the payroll tax and the other things like that? These are very basic. And give a gift to the daughter. You know, if you want to pay for a tuition, have a scholarship set up and have the company pay for it that way. Don't have it a part of the salary, because it's very misleading. The other thing that we strongly recommend, and they have done, is get audited financial statements. So the financial statements have some credibility to them from a reputable regional CPA firm. And these things have added significant value to the estate planning and the value of the company as a whole. Again, it was more than just number crunching. It was going through a process to help the company go to the next level. We collaborated with the accounting firm, who I've had the pleasure of working with previously, as well as a very good estate planning individual attorney who can go through and memorialize this and put together the plan for it. And I think it turns out to be a win-win situation. And this is the details are provided in the case study, which we'll share with all the listeners. But this is a case where it turned out to be a win-win scenario for everyone. It's just collaborating together and optimizing the opportunity. And I might add, planning. this individual was scared enough to plan for the future and mitigate their risk, not only their risk, but their family's risk and everyone else. Now, the next step may be when, I think someone says, well, what are you going to do next year? What value can you add, or what do you suggest to them? I think the gifting of some of the shares to the daughters and the family members who are working in the company may be a great way to go proceed, because he knows that he's going to be retiring in a few number of years. He's over 60 years old. He can start giving out some of the shares now to his family members because he wants to give the company to his family, so he can mitigate his exposure in his tax bill in a couple of years.
Well, and part of this is also establishing, like, what are you gifting? What are you selling? And is it clean? And some of this is actually cleaning up some of the processes or understanding what are sticky issues. But for the most part, you're trying to mitigate risk.
No.
As the risk goes down, the value goes up. So it should go up over time. But it's also understanding that when somebody takes over this company, when you pass, how much do they have to clean up in order to continue forward? And so I think that, you have to figure out if you need a valuation to just put some numbers on a piece of paper, and then maybe you could call around and get some sort of, lower price. But the reality is you should really say, okay, we're going to do some of this significant strategic planning.
That's right.
And we're using the value to kind of decide when we do some of these things, how we do some of these things. Because one of the things that we've talked about is when you have a successful company that has $5 million of EBITDA at the bottom line, guess what? People are going to come knocking and they're going to want to buy your company. If they come in and you've been valuing it for 3 consecutive years, right? First of all, they might want the valuation, so you'll have to think of that. And or realistically, you have audited financials, you have internal and external accounting, you have family members that are in the business, but they are being treated the same as other people. Like those are actually things that a buyer is going to look at as being more valuable than if this is you and your son and daughter and everything is kind of loosey-goosey. You can make a lot of money, but if somebody can't kind of take that and continue with it, that's the problem. That's what the valuation expert is trying to figure out, is what is the rationale. And some of it comes back to logic. Like you said, like if I'm making $1 million of EBITDA, do I think I can rationally sell it for 10 million? Do I think I can rationally sell it for 20 million? Like some of this is not just throwing numbers out there for whatever reason. The other thing is that things are changing and current tax laws could be changing, the impact of those tax laws on business valuation and estate planning. And this is not something new. Since 2012, it's like every so often, every few years, every government switch, we have to figure out, are these exemptions going to go away? And these exemptions are very large exemptions. But what is currently happening, or what should people be mindful of, and how does that impact their estate planning?
This is a key year as it pertains to estate planning, because there's some sunset provisions in the federal law and the Internal Revenue Service law they're going to take into effect. That's going to happen at the end of this year, December 31st of 2025, and you need to take a look at that and plan for it. You need to start getting the business valuation things. Do not wait later in the year, because all the reputable estate attorneys and state are going to be extremely busy, and you got to do the planning now. The foundation is the business valuation, and things aren't going to change. You're not going to have another year end between now and then. So this is the time to jump on that bandwagon. And also, if you do the financial planning now, early in this year, you can clean up a couple of things, as we talked about before, and they'll add significant value. So when you do the next round on December 31st of 2025, your value can go up significantly as a result of that, and for the planning. Always think of this as insurance. You can't kick the can down the road. Sooner or later, you've got to pay for it. And you don't want your heirs to be worried about all this stuff because you already put it in a package, do it properly, whether it's over or under the limit of the Internal Revenue Service, but at least be able to provide them with the business valuation. And you got to prove to them that it's under. You can't just go to the IRS later on, and heaven forbid, in the case study, someone passed, and you can't say, well, it was only worth 8 million, not 16 million. Well, tell us, how did you get that number? We have to go back and reinvent the wheel. Mm-hmm. Mm-hmm. And that's not the easy part of the process, and it's very painful and becomes much more expensive.
No, I completely agree. And I have actually had some situations where the business owner did pass and they were in the midst of estate planning and it had to move directly to probate. And in some situations that I've dealt with, it wasn't as painful a process as it probably could have been. But you won't know, and your heirs won't know. And it's still like a time process, like going into probate, proving out the assets, and then getting it out. It's kind of like things are stuck in that process.
Yes. And you're right, Melissa, and it's an extremely lengthy process.
It's lengthy, and you're basically tying up all your assets so that people can't really touch them, especially if you're giving to multiple heirs. I think the biggest thing that happens in some of the gifting is an owner will gift equally to 4 children and not really understanding that, one of them is the CEO of the company and the other 3 are just kind of family members, so understanding how, and it does kind of require a team in these situations. I would say it's usually your attorney, your accountant, and your business valuation expert kind of coming together and looking at this from all of the different aspects. Can you have one person? Sure. But I think that you're then operating kind of in a funnel, and you need to understand the legal ramifications. Sometimes the lawyers filing these tax returns, sometimes the accountants filing the tax returns, but they have understanding of their space, and then the valuator understands what are the creativity in the estate planning. So the creativity should be in the plan, not necessarily in the value.
No, that's very important. And it takes a team collaborating with the client to make sure everything's done. Very rare now, even with the especially now with the IRS requiring that the business valuator be independent, accredited, and experienced. You need a team of people and to work with the client. And I might add, maybe we don't want to deep dive into too much of it, but it's an extremely complicated and complex matter, and it really has to be turned over to professionals who've done this before. And the IRS is recognizing this, as are most the attorneys, realizing, look, I got to get somebody, or you got to get the client. You need to get somebody who can get an independent accredited appraisal for this valuation.
And I will say, when you're talking to valuation experts to try to determine what you want to do, this isn't just a pricing issue. Like, you really have to understand, like, if you go to somebody and you say, I need this, and they give you a great price, and then they're like, okay, well, I want the value to be this. If they just tell you they can make anything happen, that's not insurance. Like, you really want to hire somebody that understands where the bookends are. Like, this is, like, they're the bumpers when you're going bowling. Like, we don't want to hit the gutter. We want to have the smooth sailing. So realistically, all of those people, the accountant, the attorney, and potentially the valuation expert, should be giving you the information and telling you, hey, we can't do a 75% discount. Like, that is going to eventually just be a target on your back, and you're going to be sitting there waiting to see if they find it. And you need to have people that are going to tell you the truth, even if you don't want to hear it. Like, there's a way to be creative in the estate. There's a way to have it be over several years. There's a way to have it be voting or non-voting. allow those experts to bring those kind of ideas that fit within the system and the situation that you're in.
Right. And you want someone who, from a business valuation perspective, is going to do more than crunch numbers, to show you how you can add value to it, how you can work with it, and has the experience collaborating. We all bring something to the table, and we all can work together and get it done properly.
Absolutely. Well, let's tell them a little bit about how they can reach out to you and what types of business valuations, because you actually do deal with ESOPs. And I will tell you that that is not all providers in the business valuation realm will deal with ESOPs. When it involves the DOJ, I'm out. I'm not doing that.
No, we do complex business valuations. Usually succession planning, estates, ESOPs, things along those lines. There's going to be a transfer of ownership either presently or in the future. And we collaborate with some of the attorneys. We do a lot of work in New York City, but we do work literally throughout the world. We've have offices LA, Toronto, New York, but we also work in quite a bit of work in South America, and we also do some work in London. So we have the accredited business valuators. Our team consists of 17 valuators, and we can address these unique challenges and collaborate with the others. If you want someone who can add value more than numbers, I believe that we're the team that can do that, because like you said, Melissa, you got to tell the client the good, the bad, and the ugly and be fair with them. Don't tell them the number they want. Because number one, it won't even stand up. I mean, you turn it to the IRS, or heaven forbid it ever goes to litigation, and we do testify on a regular basis in federal court. You're not going to have a leg to stand on. You say, how did you get this percentage? You can't say, well, this is what the client wanted, or, you know, you made up a story to support it. No, you got to do it right.
Yeah,
this is one of the times you don't want to monkey around with it, because it's not fair to your heirs. It's not fair to anybody. Do it right.
Yeah, and if you've learned anything from this kind of podcast, is that you might be establishing a team, and this team might be valuing this for the next 5 years while you move through this transition period. So if anything, talk to those valuators about, hey, I'm not just coming in for this one valuation, but I'm thinking I'm going to continue to do it over time. I think that's a better way to work with a professional and say, okay, maybe they would give you a little bit of a better deal. But the reality is, a lot of people in this space, it's just a pricey valuation, because it needs to be supported and supportable, and it needs to be able to stand on its own, because we are always recommending that it is attached to that tax return. And so, and realistically find somebody that understands how to not have the IRS or the DOJ or other governing bodies come back on the valuation. That's really what you want it to stand on its own and be a great product that adequately explains the story of the valuation.
And done properly and collaborate with others, it'll pay for itself.
Absolutely. Well, thank you. Yeah.
Melissa, it's always a pleasure to deal with you and your team. Thank you so much for setting this up.
This was awesome. Well, thank you. I'm sure we'll be back soon to talk about more things in litigation and other questions. But if you have any estate planning questions, please feel free to ask us and we will address it. Things are constantly changing. You have to understand that this year you do have an opportunity, and it doesn't mean, you know, like, things have been going to change since 2012. So if you ask me, nothing's going to change. But if you want the real deal, is that they are set to sunset this year. And until, like, I think even in 2012, it could have been in 2012 where they literally changed the rules on 12/31 to change the next day. So nobody knew up until the very end that it was going to be extended. So again, this could be a process that you're getting into that's going to take multiple years. So understand if it's going to be applicable to you in this year.
And get the foundation done as ASAP.
Absolutely. All right. Thanks, Michael. We'll see you again next time.
Have a great day.